Let's look at leave entitlements. Now, when we bring your leave entitlements information into your financial model via your accounting package, this information is brought both into your historical income statement and historical balance sheet. Within your historical income statement, we bring in the historical movement in the annual leave and long service leave provisions, located underneath your salaries and wages and superannuation, and we have the historical movements on the right-hand side of the sheet. If we head back to our table of contents and activate the historical balance sheet, you can see that we also bring in the provision balances for both annual leave and long service leave within your non-current liabilities. As you can see, we have the historical balances spanning across the right-hand side of the sheet here also. Now, when we forecast your leave entitlements, this is handled on the revenues and expenses sheet located underneath your salaries and wages analysis. When we model the balances for your provisions of both annual leave and long service leave, we model these as a percentage of your monthly salaries and wages expense, including superannuation. In this example, we're assuming that the provision for annual leave is equal to 25% of our monthly salaries and wages expense cost, inclusive of superannuation. Similarly, we're assuming that our provision for long service leave is equal to 8% of the same expense. We create this relationship so that our leave entitlement provisions increase and decrease as our headcount and salaries and wages expense does over time as well. If we look at January 23 as an example, we have an opening balance of 12.5 and a closing balance of 12.9 at the end of the month. This difference of 0.4 is what will impact the financial statements. When we look at the financial statement impacts of our leave entitlements within a three-way financial model, it is important to note that it is only the movements in the provision balances that affects the financial statements. Assuming that our provision balances for both annual leave and long service leave had increased during a given month, then these movements would be reflected with an increase in the balance on the non-current liability section of the balance sheet. These movements are then matched with an expense on the income statement. The expense adjustment on the income statement decreases our net profit after tax and therefore decreases total equity on the balance sheet. The increase in liabilities and the decrease in equity ensure that net assets remain balanced and the balance sheet balances entirely. Jumping back to our example, if we want to see the movement from our 12.5 to our 12.9 balance in Jan 23 for our provision of long service leave, and we want to see the movement of 0.4 hitting our financial statements, then we can head back to our table of contents and activate our financial statements. If we expand our net operating expenses collapsed rows and locate our movement in long service leave provision and scroll across our time series until we get to Jan 23, we can then see our 0.4 in the movement of our provision for long service leave hitting our income statement. Then if we scroll down to locate our balance sheet, if we locate our provision for long service leave within the non-current liability section of the balance sheet, we can see our balance increasing from 12.5 in December 22 to 12.9 in January 2023. Now, leave entitlements are just one part of our broader salaries and wages analysis within a three-way financial model. There are other areas to consider, such as salaries and wages, superannuation, salaries and wages taxes withheld, and payroll tax. However, for the purposes of this video, when we're looking at just the impacts of leave entitlements within a three-way financial model, we simply account for the movement in the annual leave and long service leave provisions, reflecting the balance change on the balance sheet, and match these with an associated movement on the income statement to ensure that our balance sheet is always balanced.